also, guys, with the conversation that we're going to be having tonight, if any of you want to jump in, please take the initiative to, jump in to ask your questions. We're definitely looking forward to answering the questions that you guys have on tonight's show. All right, so let's move forward. So, Julian, I know that you had some things that you wanted to go over, so let's get started.
Oh, sure. So, shall we reintroduce ourselves to everybody?
No.
All right. Yeah, no, tonight actually,
just tuned in.
Well, based on the conversation you and I had a week ago, I felt like today I wanted to talk about that biweekly mortgage trick that you said you weren't aware of.
Okay. That's some tips, and I have some tips and tricks up my sleeve as well, all right?
Yeah, you definitely do. You definitely do. I'm kind of excited about this one. Some people know about it. A lot of people don't. And it's really, it's called the biweekly mortgage payment trick, basically. And you will take your standard 30-year mortgage, same exact interest rate, same exact everything. And instead of making one monthly payment, you're going to make every other Friday, whenever you get paid, you're going to make a payment. And what this does, it dramatically shaves years off of that mortgage payment. So just splitting your payment in half, it's going to shave almost 6 years off your mortgage.
Wow. So we're basically helping people right now to pay their mortgages off 6 years early. Wow. So this particular
and build equity faster.
Got it. Okay. Good.
So now there's a couple. I'll give you an example. I did an example of a $325,000 mortgage, right? You basically would be saving $73,000 in interest payments if you did that. And if you chose to put in an extra payment, let's say you put in an extra $100 every time you make the payment, you would then you'd be paying off your mortgage in 20 years.
Wow.
And save $133,000 in interest payments.
Wow.
Right?
So that's a lot of savings right there.
It's powerful. It's huge. And a lot of people, the reason I'm bringing this up is because sometimes people get talked into a 15-year mortgage because, you'll save a lot more on the mortgage interest, right? And you pay it in 15 years.
Absolutely. I mean, usually with the 15-year mortgage, you're paying it off a little bit earlier, right? But obviously, it's going to be a higher payment because it's a shorter term. So the average person going to get a home today, they're getting a 30-year mortgage because most of the time they can't afford that 15-year mortgage. So they're getting the 30-year mortgage, which, I think the first couple of years we're just paying interest on that, right?
Most of it, exactly. The first, let's say the first third of your mortgage payments, the first 10 of those 30 years, like 90+% of your payment goes to the interest.
Got it. So
it's a long time before your equity starts to build up in that property.
Of course.
Right. But going back to our comparison, the reason why some people do like if they feel like, oh yeah, I can comfortably afford, in the example that I'm using, an extra $760 a month to pay the mortgage in 15 years. But then those people you're locked in, right? You're locked into the 15 years. You can't call up your mortgage company one month and say, hey, you know what? I got laid off. And instead of having the $3,500 that I'm supposed to have, I only have $3,200. The mortgage company does not care. You have no options now. You're completely locked into that payment. And you can't really back out of it. There's no flexibility. That's one problem. The other problem is now that you're locked into paying that extra $760 a month, That's money that you're not saving for your kids' college education, that you're not saving for an emergency fund when the boiler blows up on you and you need to replace it. That's money that you're not saving for retirement or for an investment opportunity, or to even pay off debts, which is a big problem for most people now, is they're just completely overwhelmed by a lot of debt. So if you lock yourself into that 15-year payment and tie up that extra $760 a month and then still have all of these other things going on, you're really not doing yourself as big of a favor as you think.
Absolutely, absolutely. Another thing too is, with as far as the mortgage, you can actually make a principal payment at any time, which is also a process that speeds up the paying off of your mortgage, right? So you can actually call your bank and let them know that you want to make a principal payment at any time. That payment doesn't go towards interest, anything like that. It goes towards what you actually owe. So most people, even if you can't, if you can afford it, let's say one time a year, you think that's good, right, Julian? At least
absolutely, absolutely.
One time a year.
Yeah, it's whatever is comfortable for you. If you do it on a just periodic, monthly, bi-weekly, whatever basis, or if you do it once a year when you get your tax return or your bonus from your job or something, it all goes to the same place, really, to build up your equity and cut down on those interest payments. Saves a lot of money.
Got it. So pretty much, Julian, what you're saying is, you can actually double up on the payments, or when we get our tax returns, we can actually make a principal payment towards that mortgage, which will pay it down a little bit more, which will pay it down on a yearly basis, correct? It's one.
Right. And even doubling up might be hard for most people. It's just not realistic. But if you can put an extra $100 or $200 a month, it's significant. The difference is huge.
Absolutely. I mean, because what's really starting to happen is a lot of people, as we've discussed before, a lot of people, are buying houses at older ages, right? So they're not able to, let's say they have to retire, then what really happens, So am I on the right track here?
Well, it's one of the things that I'm very concerned about for a lot of clients. Back in the 70s, 60s, when the whole dream of home ownership was for young married couples to, you get married, you buy a house, and people were buying homes in their 20s and 30s, early 30s, and they're buying their home with the idea that I am on a schedule. I'm going to buy this house when I'm 25, 26 years old. By the time I'm 55, my house is paid off, and I have an extra 10 years to put that mortgage payment that I'm no longer paying to beef up my retirement savings, right? Now people are buying their first homes in their mid 40s, or they're refinancing their homes in their 50s.
We're buying houses when we're older these days versus buying them when we're young. And I